I do land deals.
Awesome. Awesome. Brandy? Oh, Brandy was just here.
Hello.
Oh, there she is.
Is there more than one Brandy?
No, no, actually,
The
you're the
one-
one that was going for. But yeah.
Okay, cool.
One,
Sorry?
one and only
Okay.
Brandy.
Oh,
Yeah.
thank goodness. I'm originally from Miami, but now I live in Canada.
Oh, wow.
Yeah, I'm a Gator. I'm into transactional lending and hopefully eventually into PML.
Awesome.
Nice.
Awesome. Heather?
Thanks for letting us be here. Appreciate it. Hey, Julie.
Hey,
I'm
hey.
Heather. I'm in sub two Gator. I'm in Georgia. Connector, private money broker. I raise capital and then also co-living in the Atlanta market and looking at other future markets as well.
Awesome. Beautiful. Jamie?
Jamie from Delaware. I do co-living, I do fix and flips, and I do systems and software with AI.
Awesome. Awesome. Miss Fatima?
I'm still at work, guys. I can't speak. Okay, I'm just gonna be listening.
No worries.
that's
No
fine.
worries. You don't worry about it. We got you. We got you covered, Miss Fatima. Moses?
Hi, good afternoon. I'm in Homestead, South Florida. I'm new to this, been doing it for a couple of months now. I'm a wholesaler. That's what I'm starting doing. Currently focusing on pre-foreclosures and foreclosures.
Awesome. Beautiful. And Aaron? Aaron?
Keep muted.
Maybe something wrong with the mic. Well,
She's muting.
yeah, we'll circle around to Aaron. Jules, you wanna fire yourself away?
Yeah. So, hi everybody. So grateful to have you all here. Thank you so much for joining Chilling with Jules and showing up. We have an awesome speaker today, guest speaker Stephen. There he is, the man, the myth of the hour. So Stephen is going to talk to us all about DSCR loans and everything in between. But today we just want to focus because there's so much that we can just cover in so much that we can't cover, I should say, in 1 hour. So he is going to take it away. Yeah, definitely network in the chat. And Stephen, go for it. Introduce and let's go. You're muted.
Sorry. Thank
Okay.
you, Julie.
Yeah.
Appreciate you guys having me on. My goal here is to do a bit of a deep dive as much as possible in the time that we have. I want to go over more than just what a DSCR loan is and how they work, but kind of a lot more of the nuance and things to look out for and how to prepare either for yourself or for anybody that you might be working with using a DSCR loan. So, start with an introduction, about myself. I've been doing mortgages for about a decade. I'm about to hit the 10-year mark in the mortgage space. And since I started, I've only ever been doing non-traditional finance. So, I specialize in like the non-QM space is what we would call it. So no tax returns for clients, no using P&Ls only to qualify, real estate investors, self-employed buyers, things like that. And then I spent a large part of my career doing only reverse mortgages as well. So, I never really dove into FHA, conventional, Fannie Mae, traditional finance that most mortgage companies deal in, because I'm a very big believer in there's riches in niches. And to get really good at something and create a brand around that is very important. So that's what I've done. And so the reason I believe this is an important thing to talk about debt service loans and then doing the deep dive is I have been going to events, I've been meeting realtors, investors, and other mortgage professionals. And there's a lot of people out there that aren't even familiar with the non-traditional space and aren't even familiar with a DSCR loan is. I met realtors that have been around for 10 or 15 years as a licensed agents that didn't know that debt service products could help themselves as real estate investors or their own clients. And so above and beyond that, once you get into the deep dive of DSCR, you realize that it's a whole world in of itself compared to just traditional finance. So I'll do a quick jump or a quick topic about what is a DSCR loan. So in case you don't know what it is, a debt service loan, DSCR, stands for debt service coverage ratio. And essentially what it is a loan program that allows you to purchase or refinance real estate without having to use personal income. So everyone knows what an FHA loan or conventional loan is, and that it requires personal income to qualify, typically 2 years tax returns, W-2s, pay stubs, and so on. A DSCR loan, debt service coverage ratio, allows you to qualify using the expected property's rental income. So it doesn't even need to be actively producing rental income to qualify for these programs. And that's why these programs are so popular with real estate investors, whether they're new investors or experienced investors with a portfolio of property. It allows them to either refi and tap into their equity or actually go out and purchase these properties, typically turnkey or as close to turnkey as possible. And so the debt service coverage ratio, as it's called, is itself a formula. And that formula is debt divided by rents, or I'm sorry, by mortgage. So you take rents divided by mortgage. So you take how much the property is actively generating or can generate, and you divide that by what your mortgage payment is to be on that property. And that'll give you a decimal. That ratio is the ratio that you're looking for. And so we'll use an example of if you're currently renting a property for $1,000 and your mortgage payment is $800, and I'll do this math real quick on my calculator. You take 1,000 divided by 800, and you get a 1.25 debt service coverage ratio. That's a positive number, meaning every month the property is cash flow positive at a debt service ratio of 1.25. And knowing how to calculate that debt service ratio is important, not just to make sure that the property is generating cash flow, but because that number is very important to the lender when they're lending their money either for purchase or refinance of the DSCR loan. So that ratio is the formula that you would need to calculate and either calculate based on actual rents and actual mortgage payments or the proposed rents and the proposed mortgage payment that you'll be getting from your mortgage broker or mortgage lender. And so again, I'll remind you that the debt service program doesn't take into account or ask for any personal income to qualify, but it is still a 30-year loan, like most mortgages. It is still fixed interest rates, again, like most mortgages, and there are options to do 15 and 40-year options for DSCR, and all the rates will vary depending on the different variables of the transaction. How it differs from your traditional mortgage loan, an FHA or conventional deal, is that they do allow you to close in the name of an LLC. So you cannot buy a home in a conventional or FHA loan and close in the name of an LLC or any entity for that matter. And these loans also carry a prepayment penalty typically, meaning if you sell or refinance the home within that time period, usually between 1 and 5 years, you will be paying a penalty to do so. So one of the variables that's important to take into account when considering a DSCR loan is how long you plan to hold the property. This type of loan generally isn't advisable for someone who's looking to do a fix and flip. If you're looking to do possibly a long-term BRRRR strategy, then you might pick a loan with a 1-year prepayment penalty and sell it after the 12-month mark. That's an option. But ultimately, unlike fix and flip loans, this is meant to be permanent financing for this property. So your exit strategy is important to know for these types of loans to determine if this is actually the best step forward versus possibly a hard money, private money, or short-term bridge loan. So who uses these loans and who are they good for? Obviously, real estate investors, either new investors, older investors, borrowers that don't use conventional financing, that don't have their tax returns in order, whether it be because they're self-employed, whether it be because of the way their finances are held through their tax preparer. All of those impact whether you qualify for a conventional loan for an investment property. So most people will tell you if you can qualify to get an investment property using conventional finance, that might be your best bet, because generally speaking, the rates can be better for a conventional investment property than a debt service loan. So banks lend based, their interest rate when they lend is based on risk. If you're providing a bank 2 years worth of tax returns pay stubs, W-2s, and all of the information showing that you make X amount of dollars and you qualify to pay your mortgage payment, the bank is going to be under or feel that they have a lot less risk compared to an investor that is not showing any personal income at all to qualify. So the debt service product will generally have a slightly higher rate than your conventional finance. But most people don't make sufficient income to cover their own debts and their own homes and those of rental investment properties based on their tax returns, whether it's their W-2 jobs or because they're self-employed and they're deducting and doing all the fancy tax preparer stuff that they can do to save as much money on the tax man. And so, of course, these programs are ideal for any kind of rental property, whether it's a short-term rental, long-term rental, midterm, co-living, or pad split. Ultimately, you're buying this property using the proposed rental income. And I'll get into the nuance of the midterm rental, short-term, and co-living in a moment. So generally to qualify, and these are very broad general terms. And so these are going to be your rule of thumb when it comes to considering a debt service loan. And it's that the minimum debt service ratio is that the property at least break even. So you want to calculate your DSCR and be at least at a 1.0 to consider or be able to qualify to buy a property using this loan program, right? Most banks want to see that you're making money every month or at least breaking even, right? They don't want you to buy a property that's cash flow negative. They'll limit your
Stephen.
loan. Yes.
Can we just pause and just ask the basic, if anybody has any questions of like, what is DSR? You did a fantastic job, by the way, with calculating it and the positive. So, I mean, just any basic questions right now? Anybody?
Yes, I have
Before
a
we go
question.
into, yes,
Can you hear me?
you're on.
Yeah. I want to know if on a DSCR loan, the bank will look on the current rent, or maybe it's fully vacant, or we look at the pro forma to reach the DSCR.
So that's going to depend on the specific bank. So depending on the bank and the property type will determine if they're looking at the expected rents or current rents. And it also depends on whether you're doing a purchase or a refinance transaction. If you already own the home and it's currently vacant, some banks will not allow you to qualify for a debt service loan because because the property is vacant. Now, there are banks that will allow you to qualify using expected rents, or like you mentioned, the pro forma if it's a multifamily property. And those banks will have a different LTV and a different rate adjustment for lending against vacant properties or properties that haven't been fully occupied. So that's something I want to go into in a moment about how these programs are very different than conventional finance. There is no one set of rules or guidelines.
Right. So just a quick question with the same subject. So as a multifamily investor, in my case, most of the opportunities is where I'm buying stuff that's rented way below market rent. Let's assume that I'm buying something in $400 current rent, but the market rent it's $750, and the DSCR, the current is not so good, but I'm buying it because of the opportunity to increase rent. Will the bank like it and the fact that they can go to 750, or will go on the current?
So some banks will consider the expected rents or the market rent over and above the current the current leases, but they will have an adjustment to the interest rate, and they will have an adjustment to how much they're willing to leverage, meaning the LTV may be less because they're taking on additional risk because the properties are not actively generating the higher cash flow. But yes, some banks do take that into account.
Gotcha. Thank you so much.
No problem.
Thank you, Stephen. And one question in the chat, is there a minimum ratio or do we just need to be positive?
So there is no minimum ratio. In fact, there are banks that lend using a no ratio, meaning that they don't calculate the debt service coverage, and they'll lend if you have the sufficient down payment. So they'll essentially require that instead of putting the 20% down minimum, which would be the industry standard, they may have you bring in 30% and not calculate debt service ratio at all as part of the approval process. And so generally you want to be cash flow positive, right? So most people don't want to buy a property that loses money every month, But I do know that sometimes investors buy property for expected appreciation. Some people buy property for the tax breaks that they can get for owning real estate, help them offset W-2 income. So there are banks that don't require that we do a debt service calculation as part of their approval with that in mind. But keep in mind that rates will be higher on those programs than they are of those when your debt service coverage ratio is above 1.
Got it. Thank
Hey,
you.
Stephen,
Yeah, go ahead.
nice to see you, by the way, again. Right?
Great to see you.
What do you see happening with the DSCR rates this year? And
That's
kind
a good
of
question.
how do you see them stacking up against the traditional investment loans?
So compared to a conventional investment loan, right now the DSCR is roughly maybe 1/4% higher, maybe 0.5% higher. So you can get a conventional loan right now in like the mid 7s, low 7s. And I'm quoting some DSCRs in, the high 7s, 7.75, 7.875. So, I wouldn't say it's well and above the interest rate that you can get on a conventional loan, but it is a bit higher, right? So some people do see a little bit of sticker shock when they hear on the news that interest rates are at 7s or below 7, and then they get a DSCR quote. But this is a very different loan. This is not a Fannie Mae backed loan. This is not an FHA insured loan. This is loan that doesn't take into account the personal income or personal assets to qualify, and is essentially lending based on expected rents for the property, with the added benefit of being able to close in an LLC versus in your personal name.
Right.
Makes sense.
So DSCR rates don't follow the exact trend of normal mortgage rates, but they tend to be delayed a little by about a couple weeks. So if mortgage interest rates are going up or down in the conventional space, the non-conventional space tends to follow within a couple of weeks, and the trend is fairly close. So if rates get very good in the next 2 years, then that means the DSCR rates will also get better. If rates continue to climb, then our DSCR rates will also continue to climb.
Right. Very good. Very good.
Thank you, Stephen.
No problem. And so going back to what the general guidelines and general rules of thumb are for these programs is that, again, the debt service ratio of 1.0, property that's cash flowing above the mortgage payment. The LTV for a purchase is going to mostly be 80%, meaning you have to bring a 20% down payment to buy a property and not have to worry about any of your personal income and qualify for the DSCR. The lowest credit score generally for a DSCR loan is going to be 620. So with a 620 and above, you can qualify for a DSCR. You may not get 20% down on a purchase or 75% as a refinance, but you'll still be able to qualify for a DSCR with at least a 620 and above. And then the property types. You've got single family residence, 1 to 4 unit, 5+ multifamily, condos, non-warrantable condos, and condotels. Those are all your typical properties that you'd be getting a debt service loan on. Anything that you can rent for cash flow positive to qualify. So now I want to do kind of the deep dive. Now I'm going to go into the real, like the nuance, some of the stuff that I see every day, and some of the stuff that can really trip up an investor or any even wholesaler dealing with buyers that are buying their properties when it comes to debt service. And so the biggest thing, and to start the deep dive, is there is a difference between working with a mortgage broker versus a mortgage lender. And so a lot of people believe that those terms are interchangeable, but they're really not. And there is a distinction between them. So a mortgage broker is a licensed mortgage person or company that works with many different lenders. And so they're able to work and find the best possible rate, terms, or set of guidelines that fit the type of loan you're looking for. The benefit there is instead of a client having to pick up the phone and calling 25 banks to see if they can get a loan, they can go to a mortgage broker that is familiar with the lending guidelines at the 25 to 30 different banks they might be working with. And I use that number specifically because I work with about 30 different mortgage lenders just for DSCR. And so, so you might think, why would you work with so many different lenders? What's the benefit there? Seems like it's overkill. The reason being is that when it comes to this loan, because there is no Fannie Mae, there is no Freddie Mac, there is no FHA, there is nobody that dictates the lending guidelines. So whichever mortgage bank that wants to offer this product essentially can determine and create their own set of guidelines and requirements that they can lend on. Meaning, when it comes to Fannie Mae, if you're getting a conventional loan, it doesn't matter if you go to Rocket Mortgage, it doesn't matter if you go to PRMG, it doesn't matter if you go to any of the big names, right? They've all got the same conventional loan. At that point, you're only shopping interest rate, right? Why would you go and shop different banks for conventional loans? Because you're looking to get the best rates, terms, and fees. But the loan program itself is the same because all those loans get sold to Fannie Mae. All those loans get sold to FHA, and the guidelines are set by them. There's only one set of conventional guidelines. There's only one set of FHA guidelines. When it comes to DSCR, there is no government-sanctioned entity, GSE, that buys these loans. These loans are bought by companies like real estate investment trusts. They're bought by hedge funds like BlackRock and Blackstone and all of these major companies. They buy these loans and they sell them as mortgage-backed securities. So because there's so many different buyers of these loans, all of them have their own nuance and their own guideline requirements for who can qualify and what they will and will not accept to approve a loan. And so there are benefits to going direct to a lender, because if you qualify for a loan with that lender, it's possible that you can get a better interest rate, right, going direct to a lender, but 9 times out of 10, the pros outweigh the cons of working with a mortgage broker, in my slightly biased opinion, because I am a mortgage broker. But there is that distinction, and it's important that you understand that, because if you're in a situation where you're being told you don't qualify for a debt service loan, or the rates and terms don't seem favorable because the person hasn't been able to actively or properly shop, then it's possible that you might need to ask the question flat out, right? A lot of people, don't think to just ask the question, are you a broker or a lender? How many lenders do you work with as a broker? Because there's also plenty of people that I know that are brokers that only work with 1 or 2 lenders. And you're still not getting the benefit of working with a mortgage broker if they're only shopping your loan to 1 or 2 different lenders, like secondary investors. So I'm going to go over, like I said, all the different nuance. So while...
Hey, Stephen.
Yeah, go ahead.
Stephen, real quick, before we keep going, let me ask you a question.
Sure.
It's kind of a 2-part question, right? So in the next year and a half, maybe 2, where do you see Fannie Mae?
That's a tough one. With the current administration, it's very possible that they try and privatize conventional finance, and maybe they eliminate the need for Fannie Mae, because Fannie Mae is not part of the government.
Yeah,
Fannie Mae is a
exactly.
government-sanctioned entity, but they are not the government. So right now, Fannie Mae was created to help buy mortgages to lower interest rates. So before Fannie Mae existed and before loans were being sold to them, interest rates were at 16, 17, and 18%. But it's also very possible that they eliminate that current arrangement with Fannie Mae and Freddie Mac, which are the government-sanctioned entities.
And so the reason I'm asking you is because there's a second question coming right behind it. I believe that Fannie Mae in the next year and a half, maybe 2, is going to be bought and they're going to disappear. That's just me, But a lot of people understand Fannie Mae being, if I want to buy a house or want to buy something, Fannie Mae is like the first question that comes up, right? Or the first thing that comes up, and nobody seems to take a minute to understand where the mortgage broker comes into play. And so what I wanted to do, maybe now or maybe a little later, is for you to give me a rundown, or our people here, a rundown of what it's like for me to walk in and say, hey, Stephen, I found property here on 123 Main Street, 10 doors, and go from there, from beginning to closing. just so that
Yeah.
they can have an idea that Fannie Mae is not just a one-way lane. There's actually about 30 lanes that you can actually go through with 30 different options that could probably benefit you to have a sit down with you and look at those options, right?
Right, of
Yeah.
course. So, we can
And
talk
Stephen,
about
just to piggyback
Yeah.
on that too, also the one advantage of going to a broker versus a lender is and correct me if I'm wrong, would they only have to submit one application versus, when you're shopping around and you go into different lenders, you're gonna be wasting your time. So think of Stephen as he's in your pocket, or a broker, whichever broker you go to, they will go to the different lenders. And, one of the key questions that he said was to ask them, how many lenders are they shopping for you? This guy has over 30, some of them are only going to have like 2 or 3. So that's huge.
Right.
So go
Right.
ahead, Stephen.
And
Thanks.
the 30, for example, is just for the debt service product, right? So, of the lenders that I'm working with, at least at my brokerage, is I'm probably approved with like 80 or 90, because between all the different programs that I'm offering, there's different lenders that specialize in those programs that I have to be approved with and familiar with to be able to sell them business.
So the idea here, folks, is not to get stuck on one lane. You have the option of coming to that one person that has multiple amount of lanes with multiple different amount of options for you. And so
Correct.
that's why we have Stephen here to just break it down for you guys. Okay.
Absolutely. So
Stephen, fire away, my guy.
no problem. So now going into the examples of the nuance when it comes to debt service loans, there's many different programs, many different lenders, as I've explained, and all of them are going to have their own little difference, their own little guideline, their own little niche to be able to sell, right? So they also got to differentiate themselves a little bit. So an example is some lenders and most lenders require that you have some sort of experience as a real estate investor to qualify to do a debt service loan, right? So, but when it comes to the nuance of it in terms of experience, is how is experience defined? So some lenders define experience as having had any ownership interest in a property in the last 3 years. And that to one lender might be sufficient. However, there are lenders that exist that require that the experience be that the borrower have at least 1 year of landlord experience receiving rents for the past 12 months. So if you just purchased a property sub 2 last month and you went to a lender that requires that you have 12 months of experience as a landlord to qualify, that lender would not accept your experience to qualify for a debt service loan. Whereas if you find a lender, in this case, I have lenders that I work with, that they define experience as any ownership interest, meaning you could have been on title to that property for 1 month. You could have just purchased that property last week, but you now have ownership interest in other real estate that qualifies you for the experience guideline. And so, if you're working with a lender / broker that only has the one guideline that requires 12 months of landlord experience, then that little nuance, you might have walked away from that conversation. You might have walked away from that meeting thinking, well, now I have to wait a year before I do a debt service loan, or I have to purchase my own primary. Some lenders require that you own your own primary residence before qualifying. They won't allow you to do a first-time home buyer DSCR loan. Meanwhile, there are lenders that exist that will do that. So I have a lender that will do, I have a few lenders that will do first-time home buyer debt service loans. But this is now where the nuance comes into play. It needs to make sense. If you're living in Miami and you're renting in an apartment near your home office or near an office where it is that you're working, and you're looking to do a debt service loan a few blocks away for a similarly priced home to where you're currently renting, the mortgage company, the underwriter, is going to see that as you trying to use a debt service loan to buy a property to live in. So it's going to be very hard for us to convince a mortgage company and underwriter that you're not going to be moving into that property. But if you work in Miami and you're currently renting in Miami and you're going to buy a property in Detroit, a property in Georgia, a property in Oklahoma, Ohio, anywhere outside of the state, well, it'd be very easy to show the lender that, look, I work here. This is my office. Here's my home where I'm currently renting. I'm very happy with my rent rates. I'm wanting to invest my money in another state. Well, that's a very simple way to explain to an underwriter, why is it that you don't currently own a home as a primary residence, but are wanting to invest? So as long as it makes sense, you know, and I've had cases where, and this is an actual transaction that I did, is this client lived in a penthouse in Brickell. He had something like a $9,000 a month rent, and super nice penthouse overlooking the water. He was buying a $200,000 house in Orlando. It was very obvious that he wasn't going to move out of his penthouse in Brickell. This guy was basically a crypto millionaire, and move out of a penthouse in Brickell overlooking the water to move into a $200,000 home near the Disney park. So I presented that information to the underwriter, and I explained, why is it that a first-time home buyer is buying a piece of real estate and not their own home? And he didn't want to own a home. He was more than happy to rent in Brickell and then buy somewhere else. And so depending on where he would have gone, some banks would have flat out denied him for just being a first-time home buyer without looking at the details and finding a lender where that nuance could be overcome. And these are all, every example I'm giving, guys, and all the nuances that I'm going to be going through now are actual transactions that I've worked. They're actual deals that I've seen, and I've either seen them blow deals up, or we've had to find a way to overcome this hurdle through some form or fashion.
Stephen, real quick.
Yeah,
I'm sorry, Julie, go ahead.
No, do you want us to interrupt you during to answer the questions in the chat, because it may pertain to what you're doing, or you want to wait?
Yeah. Just,
okay.
We'll fire away.
So, Brandy asked, would your personal home be considered experience to some?
Sorry, what was it?
Would your personal home be considered experience to some? Because you're saying like some lenders would use like, the 1 month to be considered, but is your home
personal home to some lenders is or would be considered experience? Essentially, what you would be considered at that point is a first-time investor. So some lenders allow first-time home buyers, some lenders allow first-time investors, and some lenders don't allow either and require you to own your home and be an experienced investor to qualify. The goal is to find the one specific to your situation. If I know you own your primary, but you don't own other rentals, I already know which one of my lenders allow first-time investors specifically. If I already know which ones allow specifically first-time home buyers. And then, of course, for the most experienced investors that own their primary, own rentals already, I know where to take them to get them the best possible interest rates.
And so that was kind of where my question was going to go. And Brandy just nailed the question to that. Is every structure has a story behind it. So it's not like, I just want to buy a Honda because I like the Honda. There's got to be a story why you like that Honda, right? So when you go and submit an application for someone, in this case, Brandy, there's a story as to how we can get Brandy qualified for a loan for a property, for that matter, and then scale her out to be an investor along the way. Am I right about that?
Correct. Exactly right. Yeah. Absolutely correct. Good. And so one of the scenarios, and this is a loan that I'm actively working right now, this client had their home listed for sale, and this is something I'm seeing a lot now. They were doing a fix and flip. They received fix and flip financing, which is a short-term loan, typically 6 to 12 months. And their goal is to rehab the property in that period of time and either list it to sell or refinance out of the hard money loan before the maturity date. So now the markets in certain markets are cooling, right? Homes are not selling within a week. Their days on market are going from 30 to 60 to 90 days. And so this person, their maturity date was coming close. Their goal was to sell. They wanted to do a fix and flip, but their maturity date is looming, right? So if they don't sell by that date, they're going to start paying penalties. They have to pay extension fees, and it could damage their credit if they start missing payments, right? So unfortunately, a lot of people don't always plan for the worst. And the worst is the home doesn't sell and the property, you're at the end of your 12-month term. So 30 days before his maturity date, he said he decided, I'll refinance the property and put a tenant in the home. A lot of lenders don't like to lend money, especially do a cash out transaction to give you money in your pocket when the property was recently listed for sale. And the reason for that If a mortgage lender is about to give you or lend to you upwards of $200,000, $300,000, $400,000, and of that $100,000 is going to your pocket, but you had the property listed for sale less than 30 days ago, or less than 60 days ago, or within the last 6 months, in the lender's eyes, you're taking that money and you will sell that home at any point in the next 6 months, right? So when the lender sees that you recently had it listed for sale, they're thinking you still want to sell it. So unless something has materially changed, that person's most likely going to sell. Lenders lend for one reason: to gain interest income, right? They make their money off the interest. Everyone knows that banks make money on interest. So they don't want to shell out $300,000-$400,000 as part of their mortgage, only to have that property sold 6 months after they've closed. They didn't make any money in those 6 months, at least not what they wanted to, right? Banks are always projecting that you hold the mortgage for at least 7 to 10 years. So that's how they handle, like they do their own internal pro formas on how much money they'll be making based on the mortgages they've closed. And so this client came to me, just took his property off the market looking to refinance. Now, most banks have a requirement that it be at least 6 months from the most recent list date to receive cash out from your real estate. But there is a lender, or there's actually two, that will let me do a cash out on a property that was recently listed for sale. But that little nuance that he was told, and luckily he spoke to another sub 2 member, he was told that he couldn't get the loan, and now he was rushing to try and sell it sub 2. He was trying to find any way to get out of the property until he was referred to me, where I was able to help him do the DSCR, get the cash out he needed to pay off not just his hard money, but he also had some private money that he used to help actually do the rehab on that property. So that nuance was very unique. And I actually was only able to find 1 or 2 lenders that actually allowed that refinance in the, total scheme of 30, 40 different lenders that exist for this. Different lenders are all going to have their different acceptance of short-term rental versus long-term rental, or even midterm rental. So sometimes properties, investors will get them under contract with the intent to put them on Airbnb, or do some sort of co-living, or do some sort of pad split. And the property cash flows as a pad split. The property cash flows as an Airbnb, and it cash flows as a midterm rental. But 90% of the lenders that lend to this type of product are using long-term rents to qualify. So knowing which lenders accept short-term rentals can be very important. And then the next step above and beyond whether they accept short-term rental is understanding if they're going to use the AirDNA. Are they going to have an appraiser do a short-term rental analysis? If you have an AirDNA, is that document alone sufficient? Within the lender guidelines, there is a guidelines on the AirDNA specifically. That AirDNA report that gets generated when you go on their website, it tells you what the property is expected to rent for based on local data. But there's also, it'll tell you how many comparable Airbnbs there are in that area. Some lenders require that there be at least 7 comparable Airbnbs for them to consider the AirDNA report. So you may pull an AirDNA report in a rural part of Georgia or even a rural part of Florida and think, oh, this, the numbers look great. Here's the AirDNA report, and I know that I can get this done through an AirDNA DSCR loan. But if you only have 3 comparables and not the 5 or 7 that's required, then we can't use AirDNA at all. And then as a long-term rental, that property may not cash flow. So if we're not cash flowing as a long-term rental, that could be a huge speed bump, huge hurdle to qualify to buy that property, with a decent rate, right? Without having to use a hard money loan. And so, understanding that nuance exists and having that preemptive conversation with your lender, your broker, whoever your finance person is, that's incredibly important to avoid getting under contract, putting up an escrow deposit, and then finding out after your financing contingency is passed that you're either not going to qualify for the loan you were expecting, or the rates, terms, and fees are going to change significantly because now you need to do a no ratio DSCR. So when the ratio on the DSCR is above 1, you qualify for the best possible debt service loan. The property's cash flowing, your credits, let's call it, above standards, above 700, and it cash flows as a long-term rent. From the bank's perspective, for this type of loan, that's the lowest risk possible. You're buying the property, so you're coming in with skin in the game. So you're bringing in the 20% down. You've got the credit and the property cash flows on paper. That is the slam dunk deal, easy to put together. As soon as you start getting into the unique situations where you're buying a property that as a long-term rental doesn't cash flow, so now we have a debt service ratio under 1.0. Now the property's losing every month. There are lenders, and there's plenty of them, that still lend in that situation. But because the risk is higher in the lender's eyes, the rate is going to be significantly higher. You go from getting a 7.875 interest rate, possibly to an 8.5, 8.75, because the lender has to price in their additional risk into the interest rate. And they might also want to mitigate their risk by requiring that you bring more money down. So instead of doing a 20% down mortgage, if the property doesn't cash flow above 1, they might have you bring 25% down. So now you're bringing in, you have more skin in the game, and the rate's still going to be higher in that case. And that's if the ratio is under 1. Above and beyond that, and to continue to complicate things, guys, and to add more nuance, and that's the word of the day here, to add more nuance is that knowing how far below 1.0 is also very important. So there are lenders that advertise under 1.0 programs, less than 1.0 ratio programs. But you need to be careful, because if those lenders have what I would call like the floor ratio, they might have a floor ratio of 0.75. So if the long-term rents aren't enough to cover 0.75 and above, but under 1, and you're at 0.5, 0.6, or whatever the case might be, then you don't qualify for the under 1 program. Now you need to go down to another tier, which is the no ratio program. And in the no ratio programs, you have to put even more money down, and the risk in terms of the lender's eyes goes up even further, and therefore so does the interest rate. So instead of bringing 20% or 25% down, you're now looking at 30% down with a rate in, again, still the high 8s. And so
Stefan, just for recap purposes, because some of us understand this, but for the ones that don't, if somebody is looking for how to distinguish that rate that over that 1, how do you suggest that they go find that rate?
The only way to get pricing for this is to actually talk to a mortgage person. And you could do this, talk to a mortgage lender, loan officer, mortgage broker. You'd have to ask them, present them with this certain information, and they can then give you rates based on the information you've given them. So,
but now if they're looking for those rates, what kind of properties should they be looking at?
It could be any kind of property. It can be a single family residence. It could be a duplex, triplex. It could be a manufactured home. It could be a condominium. It could be a modular home. It could be a condo-tel. So there are lenders for every one of these property types, multifamily, mall
So those
apartments.
DSCR and those rates fit any type of property here.
Correct. Exactly.
Okay.
And so
Perfect.
you find that property, if you find something online, if you find something through a wholesaler, the goal is to take that information, provide it to your preferred mortgage professional, say, this is what we've got. This is my credit score. This is the property's expected cash flow. This is the down payment I'm comfortable putting down. And then at that point, the broker will take that information and determine what rate you can offer, what can be proposed at that interest rate. I'm sorry, for that type of property.
I have a question real quick. Jumping back to the short-term rentals. So you're saying most of the properties that you're going to look at, you underwrite on a long-term LTR basis. So I'm focused on co-living, pad split model. So do you fund most of those? And like how can you just give us a quick breakdown on how you would get us a DSCR loan on that? And it also is it nationwide?
So when it comes to co-living and pad split, most lenders are against those types of properties, right? So, what happens is the bank has to think of, in a worst case scenario, if this person defaults on their loan, we need to figure out how to disposition this house as fast as possible. If it's been split into a co-living home, you take a 5-bedroom and turn it into a 9-bedroom, then it's going to be a lot more difficult for them to take that house, list it, and sell it to your typical, single family residence buyer. So very few lenders are lending in that space. So they do exist, and generally they have certain parameters that the home needs to stay within for them to consider lending, and it can still be done. But ultimately, if the property that you're purchasing is just your typical single family residence right now, it hasn't already been converted to a pad split or a co-living situation, then you can get your regular debt service loan. We just need to make sure that it would qualify using the long-term rents. And if it doesn't qualify using long-term rents, we need to look at our options, meaning, do we do this loan as an under 1.0 loan, or do we do this as a no ratio program? Or does the Air DNA report sufficiently support rents for us to qualify using the Air DNA programs? So
That makes sense.
that's the way I would go about it. If it's already a co-living property, we have to do what's called getting an exception. So the beauty about these types of loans, the non-conventional loan, is even if we have guidelines that dictate they won't lend on a co-living property, or guidelines that dictate they won't lend because of whatever nuance, all of these lenders, and they advertise this, they do allow for exceptions. If you have a very strong borrower, great FICO, above 740, they have, plenty of assets in the bank account, they have 24 to 36 months of mortgage payment reserves in their bank account. They own 15, 20 pieces of real estate. They own, or, to be honest, anything over 2 or 3 is impressive in these banks' eyes. They're an experienced investor, strong credit, strong reserves, and the property is a great property in a great area. We can go to the lender and say, your guidelines say that we can't do this because of X, Y, and Z, but I have a very strong borrower in a great market looking to buy this property. Can we make an exception to the lending guidelines to get this done? And because in these cases, these types of loans, it's not being sold to Fannie Mae, the lender themselves makes the decision, and they say, yes, you know what, we do want to lend to Julie. She is a strong investor. She has, and in fact, in some cases, I've done and gotten exceptions for borrowers that had already received a loan from that specific lender and has made every payment on time for 24 months and came back and did another loan. So I was able to pull that and use that as what we call a compensating factor. So I said, here are all the reasons why you should lend to this person. They have all of this going for them. There's no reason we shouldn't lend them money. And the exception gets reviewed, they committee it, and they decide, yes, we want to lend to this person. They have a strong track record. Let's make this happen. And that is very, very common to happen in the non-conventional space. In 2023, I get a report from my lenders. I had an average of 1.2 exceptions per transaction over all the loans that were originated. So essentially, every loan had at least one type of exception to get approved. And so that's how common it is to do that with these loans. You just need to know how to present it to the lender and what to go looking for to see what these lenders are looking to consider as a compensating factor.
So at the very end of the day, again, it all falls back to the story.
Right. It's what story can we put together, and can we give the lender confidence that the loan will be repaid and will be repaid on time without fault, right? So a lot of people believe that lenders lend with the hope that they get to take over and foreclose on a property. But what most people don't realize is that foreclosure process is very expensive. Takes a lot of time.
Yes, sir.
It complicates things, right? Banks want easy money. They want to be able to lend the money, make their interest over time, let the loan get paid off over 30 years and call it a day. They don't want to be dealing with foreclosures. And so, anything we can provide as a comp factor, anything we can show them to give them confidence in the borrower will help us make those kinds of exceptions to the guidelines depending on the situation.
That's good to know. And how quickly can you fund a loan? Guarantee that, saying that we're giving you the info, we have good credit, the property cash flows were above a 1%, 1.25 or whatever. What's your process? Can you walk us through that?
Sure.
And do you do and to tack onto her, do you do nationwide?
So I do lend nationwide. So to talk to point B before I talk to question A, I do lend nationwide. And something to consider is these loans, they're considered business purpose, meaning we're lending to businesses to buy real estate. Because of that, these loans are not regulated by the nationwide mortgage licensing service. And because of that, I will tell everybody that it's important you ask anybody you're talking to if they are licensed to lend on these types of mortgages. So because these programs don't require licensing to become to be an originator, when talking to mortgage brokers or lenders, be sure to determine, are you working with an unlicensed or a licensed person to do this? I am licensed and I carry a state license to do mortgages. However, I don't actually require to have one to do a debt service loan, but I do keep one and carry one anyway. So because of that, because I don't require a license to, or these loans don't require a license to originate, I am able to do them in any state. So I don't need to carry 50 licenses. I do carry a license in the state of Florida, but above and beyond that, I do lend in other states. I do deals in Detroit, deals in New Jersey, Georgia, California, Nevada, etc. So now going back to Julie's original question, Julie, remind me, what was the question?
How long does it take to process?
How long does it take? Sorry. So how long
No,
does
you're
it take is, so my marketing answer is I have closed and can close in 7 days.
Mm.
And now that assumes that a lot of different pieces are already in place and that some of the wheels were already in motion to get that done. That is not typical. It's not normal. But it is, you know, I do have my case studies where I have closed in a week. And so, but the honest answer is it really takes about 3 weeks. You know, 21 days is the normal amount of time it takes to get one of these loans done. What happens is we start with the loan application. That's just to determine what all the nuances we talked about. The loan application answers most of them. It'll tell me if you're a homeowner. It'll give me the property's address so I can see if it's recently been listed. It'll tell me if you own other real estate, so I know if you're experienced. So that application is basically giving me the blueprint to turn around and find out where's the best lender to take this client. And so that application is the first step. You fill one of those out, and then from there I can determine what we can do. It'll tell me, yes, we can do the deal, no, we can't, or we might have to try and get an exception to get you approved. And after the application, once I've determined, hey, these are the rates that I can offer, these are the terms that we can propose, assuming everything else lines up, if these numbers work for you and you agree to those rates and terms, we get an appraisal ordered as soon as possible, and we open title with a title company of your choosing. At that point, once the report comes back and the title work comes back, the loan gets sent to underwriting. That's where the underwriter double checks my work. And they'll say, hey, Stephen, I received the paperwork. The bank statement you provided was missing page 4. Provide me page 4. The ID you sent is cut off. The lease that you provided didn't have the tenant's signature. Get me the copy of the tenant's signature, right? So the underwriter's job is to review everything we've provided and make sure that the loan does qualify per their guidelines and you know, their own internal requirements. And so they'll tell us the items that we might have missed, items that they need to get completed before we close. We'll provide that to the underwriting. They'll approve it and say, great, you've provided everything we need. The loan is now cleared to close. At that point, it takes about 1 day to generate the closing package and schedule with the title company for you to go to sign. So the part that takes the longest, the limiting factor for how soon we can close, is how fast can we get the appraisal back from the appraiser. So if you have tenants in the property and you have to wait till 2 weeks from today, Saturday, to get the appraisal report, the property inspected, that's going to slow us down. And title. Everything else that's needed for this type of loan, I can ask from any one of you, and you should be able to provide it same day. You know, entity documents for where we're lending to, have your credit report pulled, have the loan application completed, a bank statement to confirm you have the money. You know, it's all things that can be very quickly and easily be put together. So borrower requirements, borrower conditions shouldn't take more than, you know, 1 business day to put together.
Very nice. So I have a question for you from Mr. Joe. He says, do you allow second position on your DSCR?
So I guess I'll need to know a little bit more information. Are you asking whether we could do a second position subsequent or at the same time as our mortgage closing, or are you asking if you can get a second position loan after closing?
No,
Joe, you can
first
unmute.
one.
Joe, you can unmute.
Yeah, at the same time.
At the same time. So
Yep.
There's only one lender that I know of that allows that, and they only allow the second position to be up to 90% total cumulative loan to value.
So if you're doing a seller carryback, which is basically at close, will they allow that?
Yes, but again,
Okay.
the only lender that allows it only allows it up to 90%. So you would still have to come to closing with 10% down.
Yeah, no. I completely understand that. I just want to make sure that they have, like, if we're trying to do the Morby method, that we can come in at a second position. Of course, depending on the lender's requirements, whether or not do they allow the loan to come from another bank account, or does it have to come from the primary borrower's bank account?
So for the funds, it depends on which lender we're using, because
Yep.
different lenders have different requirements on whether
Exactly.
they source or season the funds. And
Okay,
so
so there's some lenders that require seasoning, some lenders do not. So do yours require seasoning?
I have lenders that don't require seasoning.
Okay, and so the ones that do require seasoning, what is that? How long is that seasoning?
Some is 30 days, some is 60 days.
All right.
So there's many different lenders. I mentioned earlier, I work with at least 30 different debt service lenders. So all of them will have different guidelines and requirements. Some lenders might require that the funds be seasoned for 60 days, but that same lender may allow gift funds. So if you're receiving these funds from a family member and they're being deposited into your bank account as a gift, then that lender will accept that that asset with a gift letter from the person donating the money. And so that might be one workaround depending on the specific situation. You mentioned the Morby method. So like I said, there's only one lender that allows a seller carry back up to 90. However, I have done Morby methods where we close on the loan. We gave an 80% loan, and then the borrowers received a loan from the seller subsequent to our closing and recorded a mortgage after we were recorded. And they were able to close using a private money lender. They took a transactional loan for 24 hours for the down payment and closing costs. And then they were able to pay that back the following day from the seller's carry back on that mortgage. That we do allow. For the sake of our transaction, we closed without a seller carry. My borrower brought the funds through a transactional lender. It didn't come from their own bank account. It came from the transactional lender's bank account. And then they were able to pay back the transactional lender the next day and record that mortgage.
Okay, great. Yeah, because see, I'm a transactional lender, so I'm just looking for DSCR lenders that can lend on the Morby method without a lot of seasoning, and so we can get a lot more deals closed. But again, it depends on their requirements, right?
Right. So like I said, I've done it and we've closed using the funds directly from the transactional lender. And it just needs to be a separate transaction. We did our closing and then recorded the mortgage immediately after. So as long as the title company is aware of how we're setting it up, we have no problem putting that together.
Okay, well, great. Well, Stephen, let's connect, man, for sure.
Absolutely. I'm looking forward to it, Joe.
And Mr. Joe, his information is there on the chat. So if you want to grab it while it's there.
Can you put it back in there? Because I joined late. I'm sorry.
Sure. I'm getting it right now.
So, one of the things I did want to talk about was that 90% LTV option, up to 90% with the seller carry. I'm a big fan of that in cases where you're trying to structure a seller carry option. The only problem with that option, in my opinion, is that one lender that allows that, because there's, to my knowledge, only one lender that allows it to happen as part of the closing on the HUD to record that seller carry, is that their interest rates are significantly higher than the more traditional options that exist. So typically what I'll do is I'll structure the Morby the way I mentioned to you, Joe, is I'll do it where there's subsequent closings, separate HUDs, separate settlement statements, and the title company just needs to be sure to record everything in the correct order. So that way I can offer essentially my more premium debt service rates and not impact the loan with their seller second.
Got it.
And so in terms of nuance, there's a lot more, to be honest, guys, that I can go into. We can talk about foreign nationals. We can talk about prepayment penalties, structuring the prepayment penalty and how they all differ. So I don't want to, because I feel like I might be talking people's ears off.
Can we do the foreign nationals? I think that's huge for us here in Florida. If anybody else, but guys, it seems like I'm asking all the questions. Well, Joe, thanks for stepping up, and Edwin. So why don't we leave the floor? Anybody else has any questions before we
Right.
jump
Any
into a
unique
totally
scenario,
different?
anything you might have seen, has anyone here been denied a debt service loan?
Yeah, I have a short question. There is a minimum amount that the DSCR will allow, like, or based on property value. For example, if I want to take a DSCR loan for a $50,000 property, will the DSCR allow that?
So I do have a lender that will lend on small loan amounts. They still have a minimum of 50,000 in terms of their loan amount. So the property would need to be worth at least $66,000 for us to do an 80% loan and be a $50,000 loan amount. Now that same lender, they have made exceptions for me in the past where they lent $42,000 on a single property, but we were doing a deal with that same client where they were buying 5 single family residences in a rural part of the country. I don't even remember where at this point. And since they were buying 5 of them, 4 of them were worth 70,000. One was worth 68,000, and the 5th property was worth 52 or 49,000. And so they made an exception for that property, even though the minimum loan amount wasn't met, because that same borrower had strong compensating factors, and they did like that piece of collateral, so they made the exception. So we were, the minimum loan amount overall, and this is across the board, is 50,000 with almost every single or any lender that lends under 100. But exceptions can be made to that guideline.
Got you. Great. Appreciate it.
So to talk on
Stephen,
nationals for
let
a
me
moment.
throw something at you, Steph.
Shoot.
This past week I've dealt with a couple people and I've kind of caught them in their own little lies. We got a friend up here, Bert, and Bert, after we hang up, I think you know him, it's my guy in the wheelchair. After we hang up, he calls me up and he's almost dying just laughing. And this is for everybody here that doesn't understand what Stephen is doing with us here, just to give you a taste and idea as to why we invite people like Stephen to our show here to talk to you guys. Give me an example. Give them an example of a lie that a broker will tell somebody here that's looking for, a DSCR loan or a property, to do a process.
So the biggest thing I've seen is bait and switch. So, the biggest thing is,
say that one more time. There was something happening like that.
So the biggest thing I've seen is bait and switch tactics from lenders, loan officers, brokers. Essentially, they'll sell you on having a great rate, great terms, very low fees, almost unbelievable. And of course, when you're shopping for a mortgage, someone tells you I can get you a loan at 5% with no penalties and no upfront fees. Well, you want to believe it so bad that you go for it and you ignore all the red flags that exist with that. And I have had clients that have it has cost them literal hundreds of thousands of dollars because they wanted to believe so bad that they were getting a better rate somewhere else. And so part of that is asking the question of like who you're dealing with. But the biggest thing to avoid that is ask for a locked loan estimate. So the loan estimate breaks down all the fees and it breaks down what's being charged, what the rates are, and whether the interest rate is locked or not. Now, I'll add to that unfortunately, because these loans are unregulated, even that document can be manipulated. So the next best thing is to work with a reputable broker, reputable lender that you have a referral from, right? Someone who's worked with them and that they haven't, left a bad taste in anybody's mouth, having done any kind of bait and switch. But like I said, I have seen actual locked loan estimates that were missing points, were missing fees, didn't have certain closing costs that needed to be included, that made it look like the borrower was coming in with a lot less money the day of closing, only to find out that the day of closing that the title company is asking them to wire an extra $200,000 to close.
Mm.
And so even that can be manipulated. You got to be very careful with that. But that's the only way to solve for that, unfortunately, is to work with a reputable person, because anybody can manipulate that document. But that itself is at least the first step to avoiding that. And so, I mean, that's basically it, right? So bait and switch is very prevalent in this space because it's unregulated, and it's very easy to work with an unlicensed loan officer or mortgage company that then can get away with stuff like that because there is no one to report them to.
There's no accountability. So this is why I asked that question, because that happens a lot here in Florida, especially down here in Miami, where the houses, especially the single family homes, are getting stacked. They're just stacked. They're everywhere. So when you run into brokers with this kind of example, now everybody here understands and can relate exactly to what you're saying.
Right. Yeah. And the
Goes into
example
the
that I was mentioning is the client had, I think it was about $100,000 in escrow. He was buying a $2 million home. He was sold on the rate from another mortgage broker. And I explained to him that, that rate isn't possible, that even if I did the loan for free and not charged any of my fees and not made any commission and asked everybody else on the transaction, the title company, to do the loan for free, that it would not be possible to get that interest rate at the terms he was proposing. He didn't want to believe me. He went forward with them. His contract, like any real estate contract, had a financing contingency that had already expired. So he was a week from his closing when the broker tells him the only way the loan is going to close is if he brings an additional $100,000 to closing. When the borrower asked the broker and told him, "You told me I was going to be able to do X, Y, and Z," the broker said, "Either do what I'm telling you or lose your $100,000 deposit." And that was the answer. So he called me a week before his closing, asking me to try and help save that transaction. That one, unfortunately, I did not have the time to do. And I told him, unfortunately, if you had listened to me 3 weeks ago, we could have closed you already, and you would have closed at the terms that I proposed, which were not far off from what he was being given, but he wanted to save 0.25% on interest rate. And it cost him over $100,000 between his down payment and additional closing costs that he had to pay.
Wow. Insane.
Yeah.
Crazy.
Joe, you have a question?
I think he's getting ready to hop off.
Oh, got it. Later, Joe. Appreciate you participating.
Thanks for coming,
Thanks,
Joe.
Joe.
Appreciate you.
Appreciate you. Yeah.
So then the
Wow,
only thing you mentioned about like trying to catch brokers in lies or even just what you could do to vet whoever you're working with, other than of course working with someone, that's known in the community. You can always go and ask for references and vet the references, actually do the job, do the due diligence. Ask for the title company that closed their last loan. Ask for the name of a realtor that's done a transaction with them. Ask for the name of a person that has actually closed a deal with them. I have no problem. There's a couple sub-2 students. I'd have no problem saying, hey, call them and ask them how the transaction went.
And it's relatively easy. It's very simple. I mean, that's like you'd be very surprised how easy that is, and yet very hard for people to do.
Right.
Just like you said, make the phone call and vet them.
This is whether it's $100,000 loan or $1 million loan, the amount of money it's a large transaction no matter what, still a large finance transaction that could impact not just your profitability, but impact what you're going to be doing with that piece of real estate over the course of the next 30 years. It should warrant at least 5 minutes to 10 minutes doing due diligence on everybody involved in the transaction, and not just me, but the title company, the real estate agents, your TC. I have unfortunately had bad experiences with transaction coordinators. Now, I didn't choose them, but they were chosen by the borrower. But, had the borrower done some due diligence, they could have found either better options, they could have gotten better referrals. So just, any real estate transaction absolutely warrants, 5 to 10 minutes of due diligence on who it is you're working with.
Very good. Very good.
I do have a quick question on that. So when Iran was asking about the minimum amount, when you said that it's like up to 66,000, is that including the ARV, or is that just a straight up, the property purchase price?
So on DSCR, we don't take into consideration ARV. So DSCR,
got it. Okay.
The property has to be livable. So it's as is value. Now, it doesn't need to be pretty. It can be, you know, unpainted, it could be older cabinets, right? It doesn't like, if you plan on doing light renovations on the property, that's perfectly fine, as long as it is livable day one. It can't have
Got it.
holes in drywall, there can't be exposed electrical, the roof's got to be in decent shape. And so, you know, I tell people, if you have the funds to do your if you have the funds to do your own rehab, you're going to buy a property using a debt service loan and then do, you know, $5,000 of rehab in it, go for it. There's no reason to do a fix and flip loan and then do a DSCR.
Okay.
I would only
makes
recommend the
sense.
fix and flip loan when you don't qualify for a debt service loan.
Okay.
So it would be
That would be
as-
another topic. That would be
Right,
another
exactly.
another topic.
So to answer the
Um,
question, it would be as is value, and
as is.
all DSCR lenders are going to use the lesser of as is or your purchase price.
Got
So, you know, the home might be worth 100, but if you have it under contract for 50,000, then the lender is going to lend their 80% of the 50,000.
That makes sense. Okay. All right. I'll let others ask questions. Then I have one more.
Hey,
Anybody
Steven,
got any questions?
I do.
Hey,
Do you
David.
do I'm good. Do you do a 70-10 or 70-20-10 loan? Where it's-
Not for debt service. So debt service, the best case scenario that we can do as a one transaction is going to be 75-15 that gets you to 90. Now, I had mentioned to Joe, who already got off the call, he was asking about doing the Morby method with sellers or using transactional funds. We do allow that as long as the transactional funds and the second behind my mortgage comes after closing.
Yeah, the 70-20-10 is the 20% carried by the seller with 10% down.
Right. So that would be 70 lender, 20 from the seller. That's allowed. The 10% technically has to come from the borrower, but if we structure it as 10% transactional funds recorded after closing, that we can do.
Okay. Cool. Thank you.
No problem. Anyone else have questions? Anyone else seen anything? Thought of an idea?
Guys, we've got Stephen here for you guys. Ask the questions. He's a brain of the operation. Obviously, you know he knows his stuff. He understands the system. He knows how this works. So ask away. This is why we have him here for you guys.
And
And
either
while-
way, you might not have a question now, but you can also always reach out. You know, Julie shared the info there. So if you want to reach out to me, you can send me a text, you can send me an email, you know, fill out the info on the link there, and we can set up and schedule an actual meeting to go over a specific situation, a specific transaction, or even just a game plan, right? If you want to sit down and just kind of plan for how are we going to set yourself up for 6, 9, 12 months from now when you want to start buying real estate, or your property will be done. You know, we could talk about what you should and shouldn't be doing if you already own real estate and you intend to take a cash out transaction on it, or you're going to refinance it in the next 6 to 12 months. You know, like I mentioned, listing that property is going to limit who we can send that loan to and get you the maximum amount of cash out or the best possible interest rate. So, you know, you might not want to list it if you intend to hold it. You know, sometimes people say, let me throw it on the MLS just to see what happens. Maybe I get a great offer, but you know, you not realizing that some lenders don't like that could impact your options when it comes to actually refinance. So yeah, if anyone wants to set up a brainstorming session, a game plan session, I'm more than happy to do that.
Thank you for sharing that, Stephen, and thank you, Jules, for
You're
bringing
welcome,
him.
love.
Thank you for saying that because I'm here. I have not done a DSCR loan. I am a broker in the Orlando area.
Okay.
So thank you for letting me know that because but I do that sometimes. Like we'll put it listing or like I sell it to my buyers, whatever, that I have it in-house, either in sub-2 owners club or whatever. So thank you for letting me know. I don't know much about, so you explaining, you know, just the type of programs that you have and how to go about it. It's perfect. It works for me.
Absolutely. I'm glad to have helped. And yeah, I mean, it's just something to consider. So depending on it, again, if you're listing for the sake of seeing maybe if an offer comes in, but you want to hold it, you know, financing will still be possible. it just limits our options. And the more options we have, the easier it is to put a deal together, because while one lender might allow this specific nuance or this specific guideline, you have to look at the whole puzzle, right? So there's 50 different things that are moving at any one moment when it comes to approving a loan. And if just one is out of place, I have to go and find another lender that happens to allow all those ducks in a row to put a deal together. And so just things to consider, and just again, a quick game planning, brainstorming session. We can go through all those nuances and see what boxes we're checking, what boxes we're not checking, to determine what's going to be the best course of action.
Got it. Do you have something like what kind the programs you have, like just some guidelines that you can share?
Not necessarily, unfortunately. I can put together very rough set of guidelines. My only hesitation with that is I don't want to say that the minimum credit score is 620, even though most lenders have that limitation, because there are lenders that will lend to borrowers with 450 credit scores on a DSCR. It just depends on the specific situation. They won't lend if you're in that situation greater than 50% loan to value. But if 50% loan to value is sufficient and the credit score is under 620, that is absolutely an option. But I also don't want to put that in my marketing, because if you put out that we're taking DSCRs for 400 credit score borrowers,
and that's what you're gonna get. Yeah.
Exactly.
A lot of headaches.
Exactly. So can the deal be put together? Absolutely. And there's so many nuances and guideline differences that I might be able to put that I can do the 620 DSCR and I can do up to 80% LTV. But if that person happens to be getting a Morby method deal, then they're getting 100% financing. Or if they want to get a seller carryback of the 15 to 20% up to the 90, then I can effectively offer a higher LTV. So there's so many different ways to put the deal together, and there's so many different ways to structure the transaction that, there would be no way for me to consolidate the 30 plus different lenders that I work with, their set of guidelines. Right. So everyone's going to have their own guidelines and requirements. I don't really have a way to consolidate that in a way that would make sense.
Yeah, I totally get that. I'm talking about like what you just said, like at least from 620 up, this could be your scenario, something to that matter. You know what I mean? Like whoever's on here that wouldn't know, kind of like me, because I don't know about the creative financing. And I found myself in a situation where I did have like a hard money lender. And if I wouldn't have had the money and I got the house at a really good deal, clean, I was going to make $100,000. And then this lender pulls out last minute, exactly what you were talking about. That's exactly what happened to me. So I had to make magic happen. And I'm like, fuck it. I had to buy cash and to be able to close on that property, because if not, I was going to lose out on that deal. But if I wouldn't have the money, I would have not been able to get, to be able to make, after everything, it was like 90 grand.
Right.
So that's why I'm saying, but they said, oh, they don't check this, they don't check that. And it was my partner and his credit is not the best or whatever, but so that's the only reason I was asking. So I'm like, man, screw that. So then everything I've been getting, I just assign it. And then, but I'm getting, you know what I mean? Like I'm doing what I need to do now. So then I could be prepared for what's exactly coming, right? All the, because I deal with foreclosures and expireds. So getting the money position exactly, like I have a house that's paid in full, but there's a whole thing I got to do with all that, It's a whole situation. So I will have to call you. But I need to know, like, what does it look like? What is the down payment? What is this, like the minimum score to be able to get, okay, you're going to be able to do 10% down or 20%. Like, I don't know.
I could definitely put something together for you and send that over. Just the general rule of thumb situation. So you have that, handy. And then I would say anything, if a sweet deal pops up and you're like, man, there's got to be a way to put this together, then reach out and we'll brainstorm it. But yeah, I can definitely have that. I've got a couple flyers already saved somewhere on my computer with a basic template of 620 score, 20% down, debt service ratio and things like that. So, what I'll do actually is I'll share that with Julie. Julie, can I assume you have like a mailing list for these people?
Yeah, everybody
Perfect.
that
Then-
attended, we'll send it, and we'll get it to you, Maritza. I'll share your email with him. Okay, I'll send it to you.
Mhm. Yeah, absolutely.
So I'll share that with Julie, and then she'll get that out to
And
everybody.
I downloaded your info, so I'll have that too.
Perfect.
Awesome.
And
Awesome.
just Stephen, for people that want to follow you, and we have it here in the chat, but for people that want to follow you, maybe on IG, FB, how do they follow you?
So my Instagram is simplified.
At Simplified Capital, it's in the one pager, but I can drop it here. All his information's in the one pager.
Yeah.
Well, the only reason I say it because a lot of people don't read the one page.
That's their loss. No, I'm just
Right.
kidding. But I just dropped it for them.
You would think, right?
If they can't open the PDF, we don't want them. No, I'm kidding.
Yeah.
Yeah, I just dropped it in the chat, guys. All right. Anybody else? I mean, Stephen, I don't want to take up much of your time, but can you talk real quick on the foreign nationals? I know you do have something on those, and I'm working with some, to invest here. How's that work?
Sure. So, the foreign nationals, they qualify under the same programs that the US, citizens qualify under. So it's the same DSCR loan, no personal income, no, we can use expected rents. They can purchase and refinance using the debt service product. The only difference is we don't require US credit. So in fact, it's almost easier for a foreign national because I don't have to pull credit, see what their credit score is. We already know that they don't have US credit, which is great. The only hurdle is instead of it being 20% down, most lenders require at least 25% down for a foreign national. So a little bit more down payment. And as a foreign national, there's usually a little bit higher interest rate. So there's what's called the pricing adjustment. So, if you put a US citizen and a foreign national next to each other, putting the same 25% down, because that person's a foreign national, they're going to get a slightly higher rate because there's no score taking into consideration.
Makes sense.
And so the only thing we do ask from the foreign national is 2 credit reference letters. So they can use any bank that they have, any financial institution that's both in the US and their country, or any international financial institution, to write a letter of reference confirming that they have a bank account, it's open, and it's in good standing. We would just need 2 of those, and it could be the same bank about 2 different accounts. Whether they have a mortgage with the bank, whether they have an open savings account, an open checking account, an open debit card, as long as they have 2 separate accounts with at least 1 international financing institution, that is essentially what we use in place of a credit report. Otherwise, as long as they're not on the OFAC list or an OFAC sanctioned country, we're good to go.
Okay, thank you. Appreciate that.
No
I'm
problem.
sorry. You said I didn't hear. It got cut off for some reason. 2 separate accounts, one here and one in the US and one where they live?
No, it could be, they both could be in their country. It just needs to be 2 separate letters. Those letters can come from the same one bank, but they need to reference 2 separate accounts, meaning they're one open line of credit and a mortgage, 1 checking account, 1 savings account, just to show that they have open financing or open types of credit with a financing institution.
Got it. Thank you.
No problem.
Awesome. All right, guys. Any last minute questions before we leave?
Just one quick one, Stephen. If you had to give somebody an advice, man, just a buyer or investor listening to you right this very second, man, to save them thousands of dollars, keep them from falling apart like that one guy with the $100 grand, what would it be?
Call me.
Amen.
There you go.
There you go.
That's perfect.
Love it. Love it.
Yeah.
That's the
Very
best way to
simple.
finish this. Love it. Call Stephen, people. There you have it.
Appreciate everyone's time.
Thank you.
Julie, Edwin, thank you guys
Yes.
for having me. And I'll
It
see
was
you
a
guys
pleasure
at the next
having you,
event.
my friend.
Thank you, Stephen, so much. Thank you.
Yeah, appreciate the knowledge, appreciate all the gems, and of course, appreciate your time. Appreciate everybody's time. Edwin, thanks for being a lovely co-host. Everyone that showed up, we appreciate you guys. Stay tuned for the next one. And Stephen, I'll be in touch. And everybody, I will have the recording within 48 hours. It's going to be on my YouTube channel. little plug for the YouTube channel. So check it out there. But I'll send you guys a link for it. If my systems guy can help me, Jamie.
He's in hot water with me. You better call me.
Uh-oh. Uh-oh, Jamie. Call her. Don't
Call her,
get Maritza
Jamie.
mad. Yeah. All right, guys. Peace
Nice.
out. Have a
Thank
great evening.
you.
Bye-bye.
Thank you so
everybody.
much.
Have a good night.
Bye. Thank you. Bye.
Bye bye.